My name is Marty Shenkman. I'm joined by a friend and colleague, Christine Pronek. Say hi, everyone. Christine.
Hi. Good morning, everyone.
Due to popular request from her last program, which got great reviews, I have prohibited Christine from drinking any coffee this morning. No trips to Starbucks before the program. So she's going to talk as if she's from Detroit, where I grew up, instead of from New York. So there you go. So this is a really important topic, and it's really complicated. It's a lot more complicated than I think a lot of even experienced and specialized practitioners realize. The nuances of non-grantor trusts are significant. I'm going to let Christine do all the heavy lifting and explain everything. I'll just pepper her with questions or needle her from now, periodically. But non-grantor trust planning is it's just a huge part of planning. Most trusts are non-grantor trusts, and all grantor trusts at some point, don't they become non-grantor?
Right, exactly. When that grantor passes, you'll have a non-grantor trust on your hands.
Right, and much less frequently, people may try to turn off grantor trust status, but that too is a challenge and not always as easy as one may hope. So Christine, let's get started. Christine's going to go through some of the basics. We're not just going to dive into, using a non-grantor trust to expand your charitable deduction and the impact of the 237th haircut. We're going to get some of the basics down, because even for those that work in this space, a good review of some of the fundamentals is always helpful, because it is so complicated. So Christine, there she is without her headset. Take it away.
Sure, thanks, Marty. As Marty just said, we're going to start with some fundamentals. We'll have a little discussion about fiduciary accounting income, distributable net income, before we get into some planning opportunities with non-grantor trusts. So again, with the basics, a non-grantor trust is a separate taxpayer for income tax purposes. It files its own tax return, has its own tax liability. It's irrevocable in nature. The trust pays tax on undistributed income. So to the extent that distributions are not made, or they're made but don't pull out all the income, the trust would pay tax on the income remaining behind in the trust, and the income that goes out to beneficiaries reported to them on a Schedule K-1 would be reported on the beneficiaries' individual income tax returns. A key thing with respect to trusts is that they have very compressed tax brackets. So where if you were an individual, I think, say a single person, you'd hit your highest tax bracket at around $640,000 of taxable income. A trust hits the highest tax bracket of 37% at $16,000 of taxable income. And that'll factor into some of the planning we talk about later with respect to, should we have this tax to the trust? Should we pass it out and have it go into the beneficiaries' brackets? There'll be discussion about that. But a key note with non-grantor trusts is the compressed tax bracket that they have.
A couple of points. Mm-hmm. I've spoken to certainly a good number of advisors who sort of take the attitude, well, golly, because of this compressed tax rate, why would you keep anything in trust? And the answer to that comment is because from an asset protection perspective, irrevocable trusts are critical to asset protection planning, and they can't always be structured as grantor trusts. And certainly testamentary trust, when a parent or other benefactor is leaving wealth to somebody, it should always be in trust, unless the amount is just so small that it doesn't pay to bother. I'm going to use a strong word, but I think it's foolish not to bequeath or gift assets into a trust. The income tax consequences are something you have to deal with, but you shouldn't negate trust planning because of that. Christine, quick question. There's been a proposal called the Fair Trust Act to assess it's really a wealth tax, but they're disguising it as a prepayment of estate tax of 1 to 3% on trust. Did you have any mention of that here, or should we just mention it now?
If you want to mention it now, I did not actually have that covered in the presentation.
So one of the problems, and if this is construed as a political comment in this one very narrow area, that's okay. The government has unreasonably viewed trusts as something that wealthy people use to cheat the tax system. And this highly compressed tax rate is certainly one of the issues. But the reality is an awful lot of trusts are created by much more moderate wealth people to protect their wealth from divorce, from lawsuits, from claims, and the income tax planning that Christine's going to talk about. There's a proposal which certainly won't get enacted now, but I think it's a sort of foreshadowing what may well come if we have a change in the political environment and composition in Washington, where trusts, and now it's at over 50 million, but that number could come way down. Trusts over $50 million are assessed a tax at 1%. And I think for trusts over $1 billion, it goes up to, I think, 3%. Think about that, though, as a wealth tax, but wealth taxes raise constitutional issues. So they've characterized it, and it's not clear to me how they've done this, but they're characterizing it as a prepayment of future estate tax. But what future estate tax if the assets are out of the estate?
Right.
And I think it's interesting, too, the way this Fair Trust Act is structured. It's not that there is an exemption for the first 50 million. They apply a 0% rate on the first 50 million in assets. So if it turns out that it's necessary to raise more money, they could readily change within the structure of the proposal itself and tax trust assets at a much lower level. And this is not that different than in, I think it was 2020, 2021, when proposals were put forth to tax all assets in a trust as deemed realization events every X number of years. And I think we need to anticipate the continued attack on trusts. And if in fact, as has been reported all over the media recently, Social Security is in worse financial shape than was even anticipated and could run out of money in not so many years from now, there are clearly going to be tax increases. And while those may take the form of eliminating the cap on FICA, means testing payments, and probably do all of the above, we could see other taxes on trust to raise money. So Christine, back to you.
Sure. Thanks, Marty. Just the last 2 points on the other slide was that the trust receives a distribution for the income it distributes to the beneficiaries, and the beneficiaries then report that income on their individual returns. So as I mentioned, you're either going to have the trust being taxed on the income or the beneficiaries being taxed on it, depending on whether or not distributions were made.
Ooh, sorry.
Oh, that's okay. So now non-grantor trusts, two basic types. You could have a simple trust or a complex trust. If the trust is a simple trust, it must distribute its income, and the income in this case being fiduciary accounting income, which we'll talk about in a moment. And it must distribute that at least annually to the trust income beneficiary. So you'll see in the document must or shall with respect to distributing income. You know you're dealing with a simple trust, unless there's language further on that makes it a grantor trust. So you always want to keep reading. Simple trusts cannot make distributions to charities. And if they did not make any corpus distributions during the year, then what you have is a simple trust. Either income was distributed, or very often what you'll see is income was required to be distributed. You're looking at what happened during the year. You see there's more fiduciary accounting income in the trust for that year than was distributed. What you can do is attach a cover letter to the trustee with the tax return and let them know your FAI for 2025 was X, the amount distributed was this. Please distribute the difference, because you want to keep them in compliance with the terms of the trust. So if the appropriate amount of FAI was not distributed, give the trustee a heads up now that the return is done and the FAI has been computed, and let them know how much more needs to go out.
Oh, I'm sorry, finish up and then I'll make a couple comments before we go on.
Oh no, I was just about to start talking about complex trust, so go right ahead, Marty.
No, finish the slide and then I'll make some comments. I'm sorry.
That's okay. For complex trusts, the trustee has the discretion for distributing income and principal. So maybe all the income might go out, maybe not. Trustee's discretion. The trust can make distributions to charities, and the trust may accumulate fiduciary accounting income, because since it's not a simple trust, there's no requirement, there's no you must or you shall distribute all the fiduciary accounting income. So that may stay behind in the trust and then of course be added to principal going forward.
So other than a QTIP, qualifying terminable interest property, or marital trust, which by law under 2056 must pay out income, please don't draft trusts unless there's an overarching reason like Q-tip requirements. Don't draft trusts that mandate income to be distributed. It eliminates tax planning opportunities in many cases, but worse, it really undermines the asset protection benefits that trusts are really intended to create. Think about it. X millions of dollars in a trust, all the income has to be distributed. You now have created an ongoing cash flow stream that a creditor or ex-spouse can attach. Why do that? And I still see trusts being drafted that way. Another quick point, just because the trust says it's a Q-tip trust and must distribute income or otherwise must distribute income, Christine made an important comment. Read on and make sure if it's a complex trust that it isn't a grantor trust, because that changes the consequences. We've seen lots of mistakes. It's complicated. Honestly, clients really, the first year that a trust is created, must have the attorney, the accountant, the wealth advisor, everyone involved in the administration of the trust have a web meeting and make sure everyone's on the same page as to what the status of the trust is. Always look for further documentation. So if you're an accountant and you're getting a trust and you're going to do the 1041, don't just get the signed trust document. And it shocks me that I've seen not infrequently CPAs preparing tax returns without the actual trust document. You got to have the trust document. If you're not comfortable reading it, get the lawyer involved at least one time so you know what you're dealing with. But go further. Just because the trust document has certain provisions, were there any actions such as a decanting, a non-judicial modification? If it's a marital trust, did the surviving spouse renounce his or her income interest in the trust to make it complete a gift to use exemption? Because the laws may change. Make sure you have your arms around the whole trust with all modifications and changes. And if your client won't let you talk to the attorney, and Christine, comment if you want, but if you're a CPA doing a trust return for the first time and the client won't let you talk to the attorney because they're worried about a bill, I wouldn't do the return. You need to make sure you have precise understanding of what it's about and have a complete permanent file for that trust.
Now, that's key. The communication between the CPA and the attorney who drafted the trust, or if that attorney's out of the picture, the current estate planning attorney for the client.
Correct.
You want to make sure, as Marty said, you have all the facts. I've seen situations where a document was provided and you read it and it's a grantor trust, but what we weren't aware of is there was a change. The grantor flipped the switch, so now it wasn't grantor anymore, it was non-grantor. You need to have every piece of the puzzle so that you know you're following the terms correctly and you're preparing the tax return correctly.
What I would also do if I were preparing, which I'm not going to ever do, Christine can do it, but if I were preparing a 1041, I mean, not for a revocable trust that you know is grantor, I would shoot an email or something to the client and say, hey, I have a fully executed trust document dated such and such a date. I have enlist whatever subsequent actions or amendments or decantings, whatever else there is, and say, this is all I have. If there's anything else missing, it may change that I'm missing. It may change the proper treatment of the trust. You got to let me know. It shouldn't be your responsibility if the client can't get you everything. And honestly, a lot of clients don't keep trust records, especially individual trustees like Aunt Jane and Uncle Joe. You may have to really dig around to get all the documents so you can button up exactly what the tax status is. And that's really an important job, and it's really worth doing because nobody else may have done it before. And,
right.
And one last thing, you know Sally, don't you?
Oh yes, gotcha.
So
it took me a second.
my first accounting job 1,000 years ago at Coopers and Lybrand, I was on an audit. And of course, I embarrassed myself by going over to the senior who had, maybe 9 months experience, so much more knowledgeable than I. And I said, who's Sally? I see her name everywhere.
And misspelled with one L.
Yeah, I didn't know there was no same as last year. Be very careful with Sally. So if I got an income tax return that Christina prepared in the prior year, I'd probably be pretty okay with Sally, but I'm going to still make sure I have the proper complete permanent file. But just because another firm, and sometimes even a larger firm, has done prior tax returns, you need to make sure that they're doing it correctly. They may have been under time pressure. The client may not have given them all the documents. Don't sally it the first time around. Get all the records. Once you have everything buttoned up, maybe you send an email to the client. I'm doing this return assuming there have been no changes to the trust. Let me know if that's not true. But the first year, do the legwork. Don't sally.
Oh, absolutely. Because to get a new client and then follow the Sally method, what a disservice to the client. They just switched accountants and they're just going to get the same thing the prior accountant did for them. You absolutely want to check the returns. Part of it should be review of the prior years to see, at least the ones open by statute, to see what happened. If there were mistakes, something could be amended and fixed. That would be part of the service you're offering to your new client.
And I've had clients ask, like, oh, why is this accountant charging so much? And the response is because they got to do their job right. And if it costs more the first year, that's fine. They have to get things set up and get a file together and review it.
Right, that's the groundwork, absolutely. So going forward, non-grantor trusts, the income is taxed, as I mentioned, either to the trust or the beneficiary. If the income is accumulated, then the income is taxed to the trust itself. The trust would pay the tax. If it's distributed, then you could have a combination. If it was all distributed, it's going out to the beneficiary, being reported on a Schedule K-1. They're reporting it on their individual return. Or it could be some went out and some stayed in. So you'd have a combination of the trust is going to pay some tax and the beneficiary is going to pay some tax. It's not being double hit. I'm going to talk about the 237th issue in a moment, but it's not because of this income distribution deduction. You're not getting both the trust and the beneficiary taxed on the same income. You're going to have an either or. The trust is paying the tax or the individual beneficiary will be paying it because of that distribution deduction mechanism. The income that's reported is net of allocated expenses. It retains its character as it goes out to the beneficiary. So if I had a trust that had some interest income, dividend income, and rental income, that would be, and there's distributions made, the beneficiaries would be seeing that in the appropriate buckets in their Schedule K-1, interest, dividends, the qualified portion of those dividends, and rental income would be identified as such on their K-1 reporting statement. The last comment here is trusts are generally required to use a calendar year. Unless we'll talk about, I don't think we cover it in this particular
I think
webinar,
we covered it in the prior presentation we did on elections for trusts and estates.
Right, there's a 645 election where a revocable trust that's now irrevocable because the grantor passed away gets included in an estate, then that trust gets a fiscal year of the estate. Otherwise, trusts are calendar year taxpayers.
Okay, your favorite topic.
I know. Thanks to the OBBA, OB3 is easier to say, OBBA, I think. OB3 is easier to say. The 237th reduction rule that's applicable to itemized deductions, and that's starting January 1st of 26. So for this tax year that we're in, it's going to be a haircut on individual taxpayers that are in their highest tax bracket. In addition, because of the way it was phrased and the exclusion that used to exist for like the P's limitation that applied to individuals on itemized deductions that didn't apply to trusts, the way this was handled in the OB3, trusts are included in this. So this 237th reduction of deductions that applies at the highest income tax level, the 37% rate, which again is for trusts at $16,000 of taxable income, the trust will start to have a haircut on some of its deductions. So some of the concerns there are if it's going to be a haircut on the charitable deductions, which right now it looks like it is, then you could have an estate that might have all charitable beneficiaries, where typically you would take your offsetting charitable deduction against your income and have no tax due. Now you could have a reduction to that charitable deduction and wind up paying income tax out of an estate that ultimately is going entirely to charities. The other thing that's a question mark right now, like the charitable haircut is known right now. The question mark is, will this affect the distribution deduction? So if that's the case, then where I just mentioned, there's a distribution deduction so that you don't have double tax on the income. If that distribution deduction at the trust level is subject to this 237th haircut, they won't have a full offset on the trust income tax return for the income that was distributed out to the beneficiaries. So now you'll have beneficiaries being taxed on their portion of income, the trust not getting a full offset. So to the extent of this reduction, the trust is also going to pay tax on income that was actually being taxed to the beneficiaries. So we're waiting and hoping for some clarification on that this reduction on itemized deductions does not bring into it the income distribution deduction. Also waiting to see if anything that's specific to a trust, like fiduciary commissions, The reason we have that deduction in a trust is because it's a trust and they're paying commission to a fiduciary. Hopefully this haircut won't apply to that as well, but that's where we're waiting for some guidance.
So let me comment and expand a little on what Christine said. We're not 100% sure, but the Joint Committee on Taxation issued its blue book. And for those of you who want to sound very erudite, footnote 102, I don't know why I remember the number, footnote 102 deals with this issue. And unfortunately, what it says is what Christine was kind of holding out a little hope that maybe it isn't, that the distribution to a beneficiary would not be subject, and I think it's 651, 661, to this 237's haircut. But according to the Joint Committee on Taxation, it will be. And that is a problem, and it's going to make a lot of things complicated. So it's not, you know, the easy answer would seem to be that there's nothing you can do. And if $100,000 is distributed to a beneficiary and there's a roughly 5.4% tax on that, what is that, like $5,400, give or take, that the trust pays, the trust would allocate that $5,400 against the $100,000 income distribution to that beneficiary and reduce the income. Now, that raises endless issues, and I'm not going to belabor it. If you want a detailed article on this, I have one that is being published momentarily. Email me and I'll send it to you. But there is a hope that the IRS may say, okay, the Joint Committee said this, but maybe Treasury is going to issue a regulation saying we're not doing it. And part of the reason they may do it is not because of their compassion for trustees and the complexity it creates, but the complexity of administering this and auditing this for the IRS is pretty substantial. But I don't think you can assume, or you shouldn't assume, that the tax is going to go only against the income beneficiary. It seems that it may under either the trust instrument or state law, but you really need to look beyond just, let's say, the Principal and Income Act. You need to look at the state law and the trust document and see what it does. And trustees are going to be not only facing the complexity of this, and even though the amount sounds small, if it's allocated year after year against income, the income beneficiary is not going to be pleased because it's a haircut on what they're getting. And if it's allocated against principal, if you have a trust that's, you know, going on for decades, that nettlesome little 5.4% haircut after 20 or 30 years is real money. And the remainder beneficiaries are not going to be happy about that. And what if somebody's spending, which we've all seen beneficiaries that are spending every penny they get and just waiting for the next distribution to make ends meet? What happens when now there's a haircut on what they're getting? So trustees are going to have to communicate. Trustees are going to probably look to their professional advisors for guidance on how to communicate. Even though the Blue Book says that D&I is not, that the reduction does apply to reduce the D&I deduction, there's some hope it may not. So if you're making distributions now, what happens if it turns out it goes the other way, which we would all appreciate because there's certainly enough complexity. So it's an important point. We're all going to have to deal with trustees, and trustees are going to have to deal with beneficiaries. And in some cases, we may find that it's ambiguous. What if the trustee has the power to adjust? Do they do that? How is that affected? If it's discretionary to make distributions, not a mandatory income payment, then maybe the trustee can decide what to do. But how do they do that? They're kind of, you know, in a pickle because the principal or remainder beneficiaries versus an income beneficiary may feel differently. What about, and I don't want to belabor it too much, Christine, but if you have to reduce the amount that's paid out on a Q-tip on a marital trust, could this possibly affect adversely the marital deduction?
Oof. I would hope not, since this is imposed on them and not a choice that they made to not distribute. Yeah.
But I don't know that we can say, you know, other than what you just said, which is logical and reasonable, but, that doesn't always apply to the tax law.
Right.
So this is going to be a nettlesome thing we all have to deal with. And there's so much more on non-grantor trusts that I'm going to stop here. If you want a detailed article, shoot me an email. I'll send it to you. I actually think I did a whole program on just the 237th reduction with Jonathan Blotmacher that should be on our website if you really want to hear more about it. So let's go on because there's so much more. But that is something that's going to be bothering us all.
Thanks, Marty. So now there's these three different buckets, these concept of non-grantor trusts. I'm doing a quick overview here, and then we're going to get into further explanation. But fiduciary accounting income, or FAI, distributable net income, DNI, and the income distribution deduction, IDD. So FAI is defined by the trust document or by state law. Generally, it's your total receipts of income during the accounting period less expenses allocated to that income. DNI is a tax concept. It's under Code Section 643A. This is the amount of income that could be passed out to the beneficiary. And I just put a note there on where it's calculated on the Form 1041 on Schedule B. The income distribution deduction would be now the actual deduction that you'd be getting for the amount of DNI that was passed out to the beneficiaries, calculated also on Schedule B. And as I just mentioned, carries out the income that's going to be reported on the Schedule K1.
Just one very quick comment.
Sure.
FAI is not simple. It's not intuitive. You really need to look at the instrument, but more importantly, in many cases, it's going to be governed by state law. So you have to make sure you know which state law applies and see what the Principal and Income Act from that state applies. Where you have entities involved, it gets even more complicated and less intuitive. And I've seen some very smart, very experienced professional trustees make errors on this. Go back and read the definitions of fiduciary accounting income under applicable state law.
And thank you for that perfect segue, because now we're going to discuss fiduciary accounting income.
Okay.
So there's both the Uniform Fiduciary Principal and Income Act, UFIPA, and Uniform Principal and Income Act, or UPIA. Depending on what state you're in, it may be following UFIPA or UPIA. I put a list here of the 8 states that follow the UFIPA, just so that you're aware of which act you'll be looking at when you're researching this for your state. But me being in New Jersey, a lot of my presentation will be based on the New Jersey rules. We follow the UPIA. Actually, I think it was a 2001 version of it. And what these acts do is they provide the guidance on how you allocate your receipts and disbursements to either income or principal. As I said, most states have enacted one or the other. And the UFIPA, I put a note at the bottom on some provisions that are contained in it. Again, there's those 8 states that would be following that. But basically, these are the overriding, the acts that you're going to be looking to, depending on what state you're in or what state the trust is in, for guidance on how to compute fiduciary accounting income, which I'll get into on the next slide a little further. Again, my conversation's based on the New Jersey UPIA rules.
Make sure you read the specific state law that applies to the trust. There may be a provision in the trust stating which state law applies. So you may have a client that's residing in New Jersey and set up a trust in New Jersey. What if they specified a different state law? If you need to get counsel involved, do it. But make sure you look at the appropriate state law, because there are differences. Many states, and this is a generic statement, when they enact any uniform law, a lot of states will make a tweak or change to it. Sometimes material, sometimes modest, but you want to make sure you're getting the right information.
So for fiduciary accounting income, under the New Jersey statute, and I put the statute reference there, items that get included in income instead of in principal are interest, whether taxable or tax exempt, because tax exempt is a tax concept. So that's included in your FAI income. Dividends are included in income. Rental receipts are included in income. And then this one Marty had mentioned before, it's very important. When you're looking at receipts from a pass-through entity, say the trust has an interest in a partnership, if distributions of cash are made out of the partnership as part of their normal operations, that cash receipt to the trust would be included in income. So it's very important to distinguish between the two. You've got FAI, which is the cash received from the partnership, versus your numbers on your K1, which are for tax reporting. So for FAI purposes, the important number on your K1 is the distribution amount. And then even within the distribution amount, you want to know if it was cash. If it was property, it's allocated to principal. We'll go over that in a moment. If it's cash, was it in the normal operations of business, or are they going through a liquidation event or something? Because then again, now we're in the principal bucket, which we'll talk about in a moment. But very important, and this is just a little tax tip for tax preparers. Some tax softwares have a box in their entry, in their organizer, input screen that asks for fiduciary accounting income. And if you leave that blank, that tax software may add up your K1 numbers and put that into your FAI computation in your tax return. So very important to look for that input. And if it's asking for FAI, put 0 if no distributions were received, or put the appropriate amount for FAI purposes based on the distributions from the entity. Don't let the software add up K1 numbers that are for tax reporting and have that thrown in affecting your FAI computation in the tax software. Just a quick little point on that. So fiduciary accounting income, this is now items included in principal instead of an income, contributions to the trust, long-term and short-term capital gains, those proceeds, returns of capital, extraordinary dividends, income that's not required to go out to the beneficiary, because if it was undistributed income, it'll be added to principal. And then getting back to the entities that we discussed a moment ago, distributions of cash from an entity that were either in a redemption of the trust interest, or if there's a partial liquidation going on, some kind of liquidating event within the partnership. And then further, it says cash received from a RIC or a REIT if it's a capital gain dividend. And as I mentioned a moment ago, distributions of property from an entity. But an important thing to note, so if you get a K1 and say you're preparing the trust return, but you didn't prepare the partnership return, someone else did, and you just have a K1 with distributions, if it's a substantial amount of distributions, or if you see capital gains on the K1, significant capital gains, and then significant distributions, I would say reach out to the accounting firm that prepared the partnership and get the details on the distribution so that you categorize it appropriately as either a cash distribution in the normal operations, which is income, or a distribution that's part of the liquidating process that maybe just begun that year, and that would go into principal.
Christine, do you have any idea what Jersey or any state provides for how you determine if it is a partial liquidation, for example?
I think in New Jersey, in the UPIA, they'll actually give a percentage of value and say if it reaches 20, and forgive me, it's could be 20 or 30% of the value of the entity is being liquidated that considered to be a partial liquidation. Don't quote me on the percentage, but there are guidelines in there to say this would fall into the bucket of a liquidation.
The reason I wanted to ask you is the concept, not the percentage, because it may be different in different states. 20% seems to sound right, but I haven't looked at it in a while. But the point I wanted to make is you may not know or think, or you may believe the entity is not making a partial liquidation, but it's not necessarily that legally there is some formal action to partially liquidate an entity, but rather if the distribution meets certain mechanical tests, it's going to be treated that way. So again, what I wanted to emphasize, a lot of the points in FAI are not intuitive. You got to go back to the statute. It's not always intuitive.
Right, because even to Marty's point with your conversations that you have with the accountant who prepared the partnership, they might say, no, that's not what's going on. But if you fall into those parameters in the UPIA, you'll have a deemed liquidating event. And in that case, that needs to be attributed to principal rather than income. Now on the disbursement side, disbursements from income under the New Jersey statute, it's half of any fees for investment advisory or custodial services, half of expenses for accounting, judicial proceedings, and other matters that involve both income and remainder interests. Trustee commissions allowed by law on income receipts. All other ordinary expenses incurred in connection with the administration, management, or preservation of the property and distribution of income. And I put in parentheses, including property taxes, because for whatever reason, to me, I always thought property taxes would make sense coming out of principal, but they're actually allocable to income. So I just kind of highlighted that there. And with respect to premiums on insurance, if they're covering the loss of a corpus asset or loss of income from the use of the asset, that's a disbursement from income. Again, this is New Jersey UPIA that we're talking about. Disbursements from principal, trustee commissions allowed by law on principal receipts or distributions. Makes sense that the income trustee commissions were taken from the income bucket. The other half of the fees for investment advisory or custodial services. The other half, the expenses for accounting and judicial proceedings. Any principal payments made on debts. Expenses of a proceeding that primarily concerns corpus. Insurance premiums not allocated to income otherwise would be allocated to principal. Estate inheritance and other transfer taxes, including penalties if they're apportioned to the trust, like if you had a formerly revocable trust that's now irrevocable and they may have this issue, that comes out of principal. And disbursements related to environmental matters, it's just another note in there on that. So now that we've gone through the basic buckets of fiduciary accounting income and income versus principal, there's the tax concepts, which is distributable net income. So this D&I, distributable net income, it's the final component in calculating a trust taxable income. It determines the maximum amount of your income distribution deduction. The deduction itself will look to what was distributed, but you know that your D&I is your ceiling on that deduction. And it determines the character of the income, as I mentioned before. If you've got interest, dividends, and rents in the trust and distributions are made, interest, dividends, and rental income are what are going out on the K-1 to the beneficiary. So in computing D&I, you're starting with your taxable income before that income distribution deduction. Add back your exemption. So for a complex trust, $100, a simple trust, $300. Add back any net tax exempt income, which is your tax exempt income after the allocation of any allocable expenses to it. Add back your capital losses that have been allocated to principal. Take out any capital gains because they're allocable to principal. And in extraordinary stock dividends, which is specific to simple trusts, those are allocated to principal, and you get to your D&I. I have asterisks next to capital losses and capital gains because in the year of termination, that doesn't factor in, that just goes out. If you're terminating your trust, any capital losses, any capital gains are going out to the beneficiaries and reported on their K-1s. Now, with respect to capital gains and losses allocated to D&I, the prior slide was your general basic, this is what typically happens. There are situations in which capital gains and losses may be allocated to income instead of to principal. Typically, they're allocated to principal, but capital gains can be included in D&I, and it's outlined in the regs. I put the Treasury reg reference here, that under these circumstances, they may be included in income. If they're specifically allocated to income per the trust document or the local law. If there is under the fiduciary's discretion, if they've decided to allocate it to income and it's allowed by the trust document or local law, and they're allocated by the fiduciary's discretion specifically to FAI to be included in fiduciary accounting income. If they're allocated to principal, but they get consistently treated by the fiduciary as part of a distribution out to a beneficiary, then it's included in D&I. And if it's principal actually distributed to a beneficiary, say not with a consistent practice, but they were actually distributed to the beneficiary, the gains, or they were used to determine how much needed to be distributed to the beneficiary, then it's included in D&I. If they're made in partial or complete termination of the trust, as I just mentioned, final year of the trust, capital gains and losses are going out, or if they're paid permanently set aside or used for charitable purposes. So this slide just outlines the situations under the regs in which you could have your capital gains and losses included in FAI instead of in principal.
Make sure you read the trust document because trusts are not all the same. The language can vary dramatically. Some documents, some forms that some practitioners may pick up may well do something that's unanticipated. And again, like we said earlier, be careful of Sally, because what if the prior CPA that did the 1041 before you took it over never read the trust document? Don't assume just because they did it a certain way that they understand what was happening.
Okay, so that covered fiduciary accounting income and income tax concepts. Now we're going to get into planning opportunities using non-grantor trusts. So this we covered in our prior presentation, but wanted to cover it again since it's specific to complex estates and complex trusts. There's a 65-day election out there. So with respect to distributions that are made for a trust, for a complex trust, you can take distributions made within the first 65 days of your subsequent tax year and have them treated as if they were distributed in the prior tax year. So for 2026, any distributions made by March 6th of 2027, you can cover under this 65-day rule, this election under 663B, to have them treated as if distributions were made in the prior year. And what this does is it allows for some nice hindsight planning, because you could come to the end of your year, just not much in distributions was made, or you want more, you want to carry more D&I out over to the beneficiary's return because they're in a favorable tax bracket compared to the trust crunch tax bracket. And not that tax is the only reason to make distributions. We look at the whole picture when making this decision. But this election gives you the opportunity to then decide up until March 6th for 27 you can look back. Now you have your whole income picture for 26. You know everything that happened. You can compute the income. You can determine D&I and say, all right, we should make a distribution out to a beneficiary. This will carry the income over to their 1040. We'll save X dollars in tax. And if it makes sense from all perspectives to make that distribution to the beneficiary, not just for tax reasons, then you get to make this election. When you make the election, let's say you want to make the election with the tax return, and $100,000 is distributed by March 6th of 27, but you didn't want to utilize 100,000, you wanted maybe 50,000. You're not locked in to whatever amount was distributed in the first 65 days. You can use the amount that you need for your election, and any excess then would be distributions in that subsequent year. You do have a ceiling on the amount. The maximum amount that can be for which the election can be made is the greater of the fiduciary counting income or the D&I, the distributable net income. So you have a ceiling on it, but you're not absolutely mandated to take everything distributed in the first 65 days and pull it back just because you made this election. And again, as I mentioned, it's an opportunity to do some hindsight planning. Now you know everything that happened in the prior year and decide where you want to have the income tax, whether at the trust level or push it out to the beneficiaries.
Christine, practically speaking, you need to know about the trust income and the income status of the beneficiaries who you might make a distribution to during that 65-day period. Do you find that when you're looking at this, you really have all that information? I mean, I would think that if the beneficiaries are having their tax returns prepared elsewhere, it's still, even with 65 days, may be a challenge to get the right information to make a decision.
I very often, when I'm doing a trust, we're actually also preparing the beneficiary returns, but I have had situations, especially if you have multiple beneficiaries, maybe we're handling some of their individual returns, but not everybody's. We reach out to that person and provide them the information and ask them if we can communicate for purposes of tax planning with their accountant. If they don't want us communicating directly with the accountant, we would say, here's something we're considering, you know, how would this, you want that communication to find out how it would impact them, because you can't just know at 3 out of 5 bennies and say, well, this works well for them. You might have just done some damage to the other 2. So that communication, if another professional is handling those beneficiaries' individual income tax returns, is important.
And I think it's important for the trustees to know that the accountant is doing just what Christine said and communicating and trying to let people know what's being contemplated so that the beneficiary doesn't get upset with the trustee, because ultimately it's the trustee's responsibility.
Okay. 643E3 on property distributions. This was also covered in the last webinar Marty and I did, but worth mentioning again here. So with respect to trusts, you can make an election that if you're going to distribute property to a beneficiary, you can have that treated as if the trust sold it, so that the trust now, if there's a gain, a difference between, you know, the value of the property on date of distribution and the trust basis in the property, if that's a gain, the trust would recognize the gain and pay the tax, and the distribution, the beneficiary gets property now with a basis that's equal to the fair market value on date of distribution and a holding period starting on day 1, because again, it's treated as if the trust sold it. What you need to be mindful of is that gain would be recognized under this election, but not losses. And it's available for complex trusts and estates. As I said, it allows for recognition of gain, but not loss. Beneficiary has the holding period of brand new because it's treated as if it was sold. And the beneficiary, if there was a gain recognized by the trust, the basis to the beneficiary's fair market value. If there was a loss realized, but of course not allowed to be recognized on this to the trust, there's 2 different bases that the beneficiary needs to keep track of and be aware of. The result of the election, let's say it was sold. If the loss is realized but not recognized by the trust, then a beneficiary needs to keep track of these 2 bases. The trust basis in the asset will be used to compute a gain on the asset's disposition by the beneficiary, or the fair market value of the asset will be used to compute a loss on disposition of the property by the beneficiary. If when the beneficiary sells the asset, if it sells it at a price that's in between what the fair market value was and the trust basis on date of distribution, then no gain or loss is recognized by the beneficiary. If this election's made, it applies to all in-kind distributions made within that year. So it's not a pick or choose. If you make a 643E3 election, then all property distributions made in that year by the trust will be treated as if sold. You'll be recognizing fair market value. The next slide gets into why you might want to do this. So one example is if the trust has capital losses, could have substantial capital losses, and so by recognizing gain on the distribution, the losses can offset the gain at the trust level, and the beneficiary now gets a fair market value basis instead of the trust basis. If the beneficiary's plans to sell the asset shortly after they're receiving it from distribution, there should be discussion on whether we want to have that gain recognized at the trust level so that the beneficiary has the higher basis and recognizes less gain. You could have multiple beneficiaries and say you're distributing different assets to them, but they're equal fair market value, but different bases, so different built-in unrealized gains. For the sake of equalizing those beneficiaries, you can make the selection so that they're each going to have that current fair market value as their basis, instead of different bases with different gains trapped in what they receive from the trust. Or if you want to shift more income to the beneficiaries and use the fair market value of the assets for the distribution, because if we make the selection, it's the fair market value now is what's looked at as the D&I component for this distribution. You'd be pushing out more D&I to the beneficiaries via the selection than using the lower basis number to suck out D&I. And again, as we've been discussing all along, you want to be careful not to create a disadvantageous tax situation. You want communication with those beneficiaries. You obviously would be speaking to them to see if this is something that makes sense, to see if it's something they're interested in, what the tax impact would be to the trust, what the tax impact is to them. Maybe the beneficiary has tons of capital losses and this wouldn't make as much sense. You need to have the communication with the accountant who prepares the beneficiary's tax return if it's not you. Getting into another planning idea, using an LLC to control FAI distributions in a simple trust. Basically what this is, as we mentioned before, in a simple trust, you must distribute the fiduciary accounting income at least annually. We also discussed how interest in an entity, such as a partnership or an LLC, let's say the LLC in this case is a partnership, that the FAI is recognized is based on cash distributions that come out of that entity in the normal operation of business. So now if you have an LLC owned by the trust, and the member of the LLC is, let's say, the trustee of the trust, you've got control over distributions out of that LLC, you can actually be controlling how much FAI is coming into the trust, which means how much is part of what's being forced out to the beneficiaries. So this is a planning technique that can be used to try to put a spigot on how much FAI you're going to have coming out of an entity interest. You can have an LLC set up and contribute, let's say, the assets in the trust into it, put the investments in there, and then use that LLC to control FAI instead of having all the FAI that's say the entity's not there. The fiduciary accounting income in the trust must go out to the beneficiary. With it held within this LLC and some control over distributions from the LLC to the trust, you're controlling how much FAI exists to be mandatorily passed out to the beneficiary. Things you have to look at is if the trust owns an interest in an LLC that retains cash rather than distributing it, so controlling the FAI, the trust may not have any corresponding FAI depending on classification of the LLC for tax purposes, the trust accounting rules under the governing instrument, and applicable state principal and income statutes. Again, you'd have to look at those to see how they handle distributions from these entities. I've been going under New Jersey law. You'd absolutely want to look to the law that's involved for the trust that you're dealing with. LLC is taxed as a partnership as an example. For FAI purposes, the trust generally treats actual partnership distributions as income or principal. As we discussed earlier, money is typically allocated to income. Property distributions and distributions that are in liquidation are allocated to principal. So if the managers of the LLC have that influence, or they would have that influence over distributions, you could potentially be controlling the amount of income, FAI, coming into a trust that has to go out to the beneficiary. And there's a little more on this on the next slide. I don't know if you wanted to say something on this, Marty.
I'll let you finish, then we'll
Sure.
talk about it.
So important limitations to consider when using this LLC approach to suppressing FAI. The fiduciary duty issues: if the trustee controls the LLC and intentionally retains earnings to the disadvantage of the income beneficiary, that beneficiary could argue that they breached their duties of impartiality or loyalty. that they're being preferential to the remainderman because they've reduced so much of the, reduced the amount of income that income beneficiary was entitled to. You have to watch out that you're not going to cause any problems with your simple trust qualification. So if the trust instrument requires all accounting income to be distributed, but the trustee has broad discretion over whether the entity distributes the cash, the IRS could question whether you truly have a simple trust, meaning you're a simple trust, you're mandating distributions, but now the trustee has a way to kind of make the FAI zero, so the distributions are zero. That may be looked at as a little bit too much control over that simple trust, especially let's say if this was a marital trust. You'd have some concerns about whether or not you've just done some damage to the marital deduction that was taken for that trust. And state law, always looking at state law. Some states have adopted provisions allowing trustees to adjust between principal and income or to treat the entity interest differently. Applicable law is critical.
So let's go back to your example of simple trust qualification. I think the potential downside, which has to be weighed when you're doing this kind of planning to control FAI, is if the trust involved is a marital trust and the IRS says the trustee is inappropriately manipulating the income of the underlying entity that maybe the trustee was instrumental in forming, you may lose your marital deduction.
Right.
So that's a big potential downside that you have to weigh the risk of when you're doing this kind of planning. How do you feel about having a manager-managed LLC and naming somebody other than the trustee as the manager? Wouldn't that seem to infuse a little more independence and not look like the trustee themselves is controlling or unreasonably controlling the distributions out of the entity?
That gives you more independence, and I guess then the question is that separate? Is that going to be accomplishing any kind of control over FAI, or if you're back in the situation of now you have no control over what the LLC is doing and you receive what you receive? I don't know.
Well,
Maybe.
I mean, it may be a friendly party, but at least it's a little more independent than just the trustee doing it.
Right. The trustee wouldn't be calling the shots on everything and jeopardizing,
Correct.
as you said, some status of the trust.
What I've seen some practitioners do is have the trust own 99 or 99.9% of the underlying entity, and then have some other family member trust family entity own 1% or 0.1% of the entity that's underlying the trust involved in our discussion, so that it's not only a independent manager, but also it's recognized as a true partnership and not just a disregarded entity for the trust that owns it. So you can infuse some more qualifications, more, that's not the right word, some more independence in the structure, but I think it still comes down to that if it's family or controlled entities or people, the optics may be better, but will it be enough if there's an IRS challenge?
Right. And it'll be interesting when we start seeing some rulings on that.
I haven't seen anything at all.
No. Okay, so now that was a discussion of the LLC on control of FAI. Now using non-grantor trust in planning for a 199A deduction. With respect to business interests that a grantor may own, if everything's kept on their individual return, they may phase out of the benefit of getting the QBI deduction. But if you have non-grantor trusts, each non-grantor trust gets its own separate QBI, so own separate threshold and own separate QBI deduction. So by spreading those entity interests out amongst trusts, in addition to whatever estate planning and asset planning protection you're going to achieve from this 199A perspective, you'll be getting a little more bang for the buck. So each one would get its own 199A deduction. So as I mentioned, you can create multiple non-grantor trusts and allocate the business interests across the trusts. Each trust gets its own deduction threshold. For trusts for 2026, the threshold for it is the $201,750 to $276,750. That's your phase-out range for getting this deduction. And in determining whether a trust has taxable income that exceeds those thresholds, you're looking at taxable income of the trust after taking into account the distribution deduction. In addition to the QBI deduction, for the entity interest, the trust can also get a deduction for 20% of qualified REIT dividends and qualified PTP income. So again, this is valuable for high-income business owners that are near or over the 199A limits. If they're interested in doing some planning for estate or asset protection, and when they use these non-grantor trusts for those business interests, they're getting additional 199A deduction. So more bang for the buck. And the next slide. So if you're creating multiple trusts, if you have a situation where the grantor has multiple trusts, what you want to be careful, oh, let me just talk a little more about 199A, sorry. The trust itself is treated as a relevant pass-through entity. Oh, sorry, Marty, my bad. It was the next slide. I just was jumping ahead of myself. The trust is treated as a relevant pass-through entity to the extent that it allocates QBI and other items to the beneficiaries, and it's treated as an individual to the extent that it retained them. So when a trust makes distributions and passes out some of that QBI to its beneficiaries, the K1s for those beneficiaries are going to have the detail with respect to that. So you'll have the footnote to the K1 giving them their relevant unadjusted, the UBIA, giving them their relevant wage information, basically all the information the individual would need to be able to appropriately calculate a 199A deduction on their individual return. So that trust itself acts as a pass-through entity for QBI purposes. And when you're looking at computing your D&I, it's determined without regard to the 199A deduction. So again, similar our partnership or an S corp passing through these attributes to an individual for 199A, the trust is looked at a pass-through entity, passing it on to its beneficiaries. What it retains, then you'd be looking at the 199A deduction that you could possibly have at the trust level. Okay. So for planning purposes, not every state follows the federal treatment for 199A. New York and New Jersey, for example, do not. So when you're looking at establishing some non-grantor trusts that you're hoping will be taking advantage of the 199A deductions, you might want to look at some states that are income tax friendly, so that you're getting your benefit at the federal level, but you're not going to get dinged on your state level. Some of those states being Delaware, Alaska, Tennessee, or Nevada, you could create a non-grantor trust there. So you don't have to worry about the state income tax portion of it. Keeping in mind though, that these entity interests that have been contributed to the trust, if they have state-sourced income, then you still will be filing income tax returns in those states because of the sourced income. So if you've got income generated from the entity that's not sourced to a particular state, and you set up the trust in Delaware, Alaska, Tennessee, Nevada, one of those states, you won't have a state income tax liability for that trust. You'll just have your federal liability, and you'll have your 199A deduction at the federal level. I did make mention in here of the incomplete gift non-grantor trusts, the ING trusts, which again set up for state income tax benefits. For estate tax purposes, they're not outside of the estate because they're looked at as incomplete gifts. It's another type of trust to be considered for this type of planning. Since it's a non-grantor trust, it does get its own separate 199A deduction. New York and California don't recognize these trusts as non-grantor trusts. They treat them as grantor trusts because the transfer was not complete. They consider it to be a grantor trust. And there's a caution here that the IRS has stopped issued rulings regarding ING trusts. So it's just a mention of another planning tool that's out there.
What many people have done because of the change in IRS a policy on issuing rulings to income intentionally non-grantor trusts is instead of using the ING structure, you can structure a non-grantor trust like a SLAT, Spousal Lifetime Access Trust, with the requirement that an adverse party, say an adult child, have to approve any distributions to a spouse, or you structure a trust that's just a dynastic trust where you don't have that issue. So some practitioners have, I don't know if this is the right descriptive term, shied away from using ING trust because of the IRS perspective. In New York and California, the ING restrictions, and as was correctly stated, the ING restrictions are only on incomplete gift trusts. So if you don't use an ING model, but you use a non-grantor trust that's a completed gift, you won't have an issue of it being respected in New York and California. And under current law, with a $15 million inflation-adjusted exemption, for an awful lot of clients, that's easy enough to do, even if they live in New York and California. There's currently a proposal called something like the Saving Social Security Through Taxing Dynastic Wealth Act. If something like that gets enacted, where they're talking about reducing the estate tax exemption from 15 million to 3.5 million, then the laws in New York and California will be much more difficult to plan around, because with much lower exemptions, you're not going to complete or structure a completed gift if you're going to trigger gift tax. But under current law, an awful lot of clients can still continue to do that. And keep in mind that the better states, Delaware, Alaska, Tennessee, Nevada, so on, South Dakota, these states remain great for asset protection and dynastic planning. So if you can favor them, regardless of the other considerations, it does make a lot of sense. It's not just the income tax.
And now if the non-grantor trust approach is used, and say you're using multiple non-grantor trusts and putting business entities in each of them to get the extra bang for the buck on the 199A, you want to be careful to avoid the anti-abuse rules, because the anti-abuse rules against trust stacking, if the trusts are not independent, and what section 643F talks about is multiple trusts get treated as one if they were formed to avoid tax. So you want to make sure you're staying clear of the IRS coming in and saying, no, these aren't 4 or 5 separate trusts, this is one. And a way to avoid it is you have a legitimate non-tax related purpose for why separate trusts were needed. You have different primary beneficiaries of the trust for that same grantor. So if the father has 5 kids, one trust for each child, you've got your different primary beneficiaries for each grantor. And you want your principal purpose of, not to be the avoidance of tax. To that first point there, the legitimate non-tax related purpose, the reasons for why separate trusts were needed and what's being accomplished, which has to be more than just, well, I wanted extra 199A deductions.
When you set up trusts for example, and that's the classic example Christine just gave of for separate kids, if you can vary more than just the name of the kid that's the beneficiary, that may be something worth at least thinking about. So if one kid is doing pretty well financially, maybe you do a different type of distribution standard for that kid. The more differences between the trusts, the better. And that also may lend support to, as Christine said, a non-tax purpose. We created different trusts because the kids have different needs. One's special needs, one's doing really well financially, one doesn't have special needs but is not doing so well financially. So those are all things that may help you with the 643F. And Christine, I don't recall seeing those regulations ever finalized. Am I wrong?
No, I think you're correct. I don't believe they're finalized yet.
So not sure how helpful the regs are anyhow.
But parameters to keep in mind when they're establishing those trusts.
Absolutely.
So use of non-grantor trust and planning with 1202 stock. Now this is for the qualified small business stock gain exclusions. Each individual has it, each non-grantor trust has it. So similar to the 199A, each separate non-grantor trust will get its own exclusion for QSBS purposes. So for someone who's anticipating a sale with a significant gain, where they're going to need more than, it won't cover it if they own the stock themselves and they sell it and their 10 times basis or their 10 or $15 million exclusion is not going to be enough to cover it, you can put some of that stock in separate buckets and have that gain protected. And again, that's in addition to your asset protection and your estate planning reasons for wanting to do so, but also you would be getting a separate 1202 exclusion for each trust. Trust must acquire the QSBS directly or by gift. So the trust can either itself make the purchase of this type of stock, or when the grantor transfers it, gift is an exception to the rule that the seller has to be the original owner. A transfer by gift, now the trust is considered to have that original ownership transfer over from the grantor.
What about a note sale to shift more value if you used up your exemption?
If you used up your exemption
That's
and
not
you're
really
selling
a gift.
it's not a gift. And I think even though if it's, well, I was going to say grantor trust, but we're talking about a non-grantor trust. In that case, the trust is purchasing it, but they're not the initial purchaser because they didn't receive it by gift.
Right.
I would think that would put you outside of being able to get the exclusion.
Yeah. And you got to watch exemption to make sure you know how much is there.
Oh, sorry, flip back for a second. I just want to.
Sure.
So the QS basis carries over and the holding period tax to the recipient to the trust when it's gifted. Upon sale, each trust claims its own exclusion. And just to go back to the OB3, stock issued before July 5th of 25, you have a $10 million exclusion or 10 times basis. And for stock issued after July 4th of 25, you have now the $15 million exclusion or 10 times basis. Just to take note of what the date of the issuance was. For estate planning, if the trust is structured so the transfer is a completed gift, then a gift tax return will be filed, your exemption is utilized, and the assets are outside of the taxpayer's estate. Best to gift the stock early because you want to get it in there at the lower value before it starts increasing and you get closer to this sale event. And just while I'm mentioning that, avoid a last minute transfer of QSBS to a trust because the IRS can come in and claim assignment of income. If it's within just a few months of when this QSBS sale took place, they could say, no, this was just you, the grantor, shifting income over to the non-grantor trust. This is really yours, and that income should be recognized by you. You did not really effectively separate that from yourself. So you want to watch your timeframes with respect to funding of these trusts and when that sale is going to take place with the gain.
It's not only timing, you also want to find out, have any documents been signed? Is there a letter agreement? Is there actually a signed contract and it's in due diligence already? Get some details and document what's going on.
Right, find out what's in place at the time that transfer is being made.
Right.
Not all states follow the treatment of QSBS. New Jersey now does, effective 1/1/26. We're following it. New York follows it as well. But depending on the state that you're in, you're going to want to look to see if you get QSBS treatment at the state level. If you don't, then you might be interested in setting up the trust in one of those tax-friendly states, as we mentioned before, Delaware, Alaska, Tennessee, or Nevada, so that you don't have state income tax concerns. So now you'd be getting the benefit at the federal level of the QSBS treatment, the gain exclusion, and also not having to worry about a state income tax because you set the trust up in a state tax, in an income tax-friendly state. And this just goes back to talking about those Inc. trusts, which we discussed before. And did I skip it? Can you go back one for me?
Sure, I'm sorry.
No, that's okay. Oh, I'm sorry if it's not in there. I wanted to mention the same concerns here. If you're setting up multiple trusts and trust stacking for purposes of QSBS planning, we're going right back to 643F again. Make sure you're not going to run afoul of those rules and set up some multiple trusts that the IRS can easily collapse and say, no, I'm sorry, this was one trust and you've got one QSBS exclusion, not multiple. That slide should have been in there, so my apologies. Non-grantor trust, the state and local tax benefits. So we know now the SALT deduction was changed with the OB3. Instead of just $10,000 that you could have for taxpayer, you could have up to, for 2025, you're able to have up to $40,000 with, as that phased down nothing when your income got over certain thresholds. They did build in 1% increases to the amount through 2029. So for 2026, it's $40,400 is the maximum amount of deduction for state and local taxes that an individual could get on their return, and the maximum amount that a trust can have on their tax return. So non-grantor trusts now, as their own standalone taxpayer, each have their own state and local tax benefit or state and local tax deduction limitation. The new limitation, the $40,400, is reduced, but not below $10,000. You can get it down to that number. You'd still be entitled to the 10. By 30% of the taxpayers' modified adjusted gross income over for 2026, the amount is over $505,000. It's a temporary increase. It'll revert back to $10,000 in 2030. At least that's how it's set up right now. As I mentioned, non-grantor trusts each get their own SALT deduction. So if the grantor has some income producing assets that they're putting in there, now that income is off the grantor's individual income tax return. It's over on the trust tax return. Trust gets its own SALT deduction, and the grantor may now even qualify to get the increased, more than $10,000 on their return based on how much income they shifted over with the assets to the trust. I forget if there's a nope. That was it.
Christine, I think it's worth just taking a second and maybe you can sort of recap, because I've seen situations where clients, advisors are looking at just QSBS, but all these different benefits. You can enhance charitable giving subject to the 237th haircut. You can enhance SALT benefits. You can enhance the QSBS benefits. You can get QBI benefits. Collectively, if a client can get more than one of these benefits, the value of the non-grantor trust planning gets even more significant.
Oh, absolutely. The additional, as we say, like bang for the buck that you can get using the non-grantor trust and separating these assets from the grantor's bucket, because whatever they retain would still have their own, SALT deductions or 199A QSBS, but now you've got a whole separate standalone taxpayer to take advantage of these benefits as well.
If you're doing something like trying to get SALT benefits out of this, but under current law in 2030, the incremental benefit is pretty much eliminated. One of the things I like is building in a lot of flexibility. So if the client has not used all their exemption, I like doing a completed gift trust. In New York, you have to do that. But why not use up exemption? I like putting these trusts in the trust-friendly jurisdictions, not only for income tax, but for better asset protection planning. If you can build in, if the client is married, a spousal beneficiary subject to the approval of an adverse party, one of the things that's valuable about that is if it turns out that in a future administration in Washington, many of these benefits are restricted or even eliminated, which all could happen, you can still get access to the trust, and the client may feel less unhappy about the tax benefits ending if they can still get benefit from it through a spousal beneficiary.
Right. Yeah, and that's why we always say that these are some of the tax benefits you can get, but you're looking at your other reasons for planning and your asset protection and your estate planning, because as you mentioned, some of these will sunset, some of them just could be taken away at a given point. Although hopefully, you do your planning for QSBS purposes, you actually get that coverage and you get that gain exclusion, and then, going forward, you're still happy with the trust because you had that happen at the time of the sale.
Right. Any practical comments or suggestions from what you're seeing that you want to share, and then maybe you could just wrap up with whatever summary comments you want to make?
I guess overall, because we were focusing on the non-grantor trust and the income tax side, don't ignore, don't overlook your gift tax reporting. So when these trusts are funded, and for communication, we talked about how communication is key with the accountant on the trust and the accountant on the 1040. It's key with the attorneys, of course, as well. When you see one of these trusts, the client gives you the trust document, says, oh, this is new for 2026, or if you're still working on last year, 2025, you want that communication with the attorney. Find out who's doing the gift tax return for one thing, and then also the communications about the terms of the trust, and make sure you're interpreting things correctly. Very often, gift tax returns fall through the cracks because the attorney thinks that the accountant's going to be doing it, and the client never mentions that to the accountant, or somehow we have a confusion in the mix. So in addition to what we mentioned earlier about communicating with the other professionals, make sure a gift tax return hasn't slipped through the cracks. As soon as you see a new trust, please start asking those questions and find out who's supposed to be handling that.
And even if you're doing an ING structure, incomplete, intentionally non-grantor trust, so it's an incomplete gift, you may still want to report it as a non-gift transaction, just so you're going on record and tolling the statute of limitations. So you may want to think about that as well.
Right. But definitely don't overlook the fact that if a trust has been funded, somebody needs to have done a gift tax return or the type of reporting Marty just mentioned, disclosure to start a statute, to make sure it didn't fall between the professionals.
Any final comments or thoughts, Christine, or we can wrap up?
I'm trying to think. I think we covered on FAI, DNI, and income tax. And
no, I think you covered a lot, and I think you did it at a understandable pace.
And my not New York pace?
No, not your New York pace. And I hope that it's going to be helpful to a lot of people, a lot of practitioners and colleagues. I think, it's always good to revisit these items because a lot of them are not intuitive, and there's so many nuances to almost every single point that you made. So thank you for your great presentation, and thank you everyone for joining, and good luck. Thanks, Christine.
Thanks, everybody.